Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, February the 26th. I'm Jay Gragnani.
And I'm Ian Saunders.
Last week of February. Hard to believe that 2 months of 2020 are already in the books, or almost in the books. Yeah. And hard to believe that the epidemic, I think it's safe to say now, is almost 2 months old. And that obviously being the coronavirus. For the first couple of months this year, we were talking just, you go back to the end of last year, and that's when we first started hearing about the coronavirus. And then the mid-January, the first person confirmed to have died from the coronavirus in China. And, for much of that time, January, late January, early February, even into mid-February, the markets really didn't see any negative effects from it. The markets, as a matter of fact, here in the U.S., the S&P 500 moved to new all-time highs just as early as a week ago. And so we're sitting here now coming on the heels of Monday and Tuesday, so the 24th and 25th, of seeing 2 days where the market was down 3% each of those 2 days, which that in and of itself is a rare occurrence for the market. And here we are recording this Wednesday where the markets have been all over the place and seemingly reacting on a lot of news, a lot of different organizations coming out, whether it's been the CDC, the World Health Organization, whoever it's been. And so markets certainly reacting to that. But I want to go back to something for a second. We mentioned earlier this occurrence that the market hasn't been down 3% in 2 consecutive days very often. And that, to put that into perspective, this is just the 10th time that the S&P has ever seen the market down 3%, going back to about 1950. And a bunch of those, so if you were to look back at that, this is the 10th time. 5 of those came in 2008 alone. So if you take 2008 out for a minute, not that we can remove that from our history, but obviously 2008 being an anomaly of a year in terms of market returns, this is only the 6th time that we've ever seen it happen, and the first time in almost 5 years, going back to August of 2015. And so, certainly that is not lost when we see the volatility picking up, we see the magnitude of the volatility picking up, and certainly seeing the impacts on that from a number of charts that we're seeing today.
Absolutely. And you mentioned there as well, most of the virus fears and the kind of headlines started to come out about that right around mid-January time frame, and that was when the S&P was making new all-time highs and also in pretty heavily overbought territory. Yeah. The S&P as a whole, just for the index in and of itself, was right around 100% overbought at the end of the week on January 17th. And now we're flipped a little bit from that, right? We were 100% overbought, and now the index is at 97% oversold. So definitely in solidly oversold territory at this point. And I think a lot of people were expecting a little bit of a pullback when we saw 100% overbought readings, but not many people were probably expecting it this quickly. But if you look at that peak to trough where we are now, kind of drawdown, we're just at over 7% decline, which obviously it never seems great when you're in it. But in the grand scheme of things, a pullback from those all-time highs, from those overbought territory, is at the end of the day a healthy thing for markets, at least in the current state of things that we're in here now.
Yeah, 7% historically is not unreasonable. The market on average pulls back 10% at least about once a year. 7% is certainly very, very normal. This one just came in a matter of 4 days, yes, which is obviously very quick to see some of that pullback, and so that's resulted in markets, indexes, U.S. In particular, moving into pretty heavily oversold levels. And as we're talking about this today, the markets were up this morning. Now they're down, and so a good chance of seeing those oversold levels push even further into oversold territory. But nonetheless, what I think is certainly worth talking about is the media certainly has a way of providing the hysteria out there and kind of fueling on that, and that's part of our lives, right? That's part of the day in terms of TV, social media, whatever it might be. And so especially in these times, I think it's really, really important to take a look at some perspective and gain a little bit of perspective. Obviously, the weekly distribution and the point and figure charts can help do that. But looking back at previous markets where we've seen similar health epidemics out there. And just kind of in recent history, there's been a number. You think back to Ebola, back in kind of beginning late 2013, and that running, really into about mid 2016. You think of H1N1 or the swine flu that started really at the end of the end of March of 2009. I think the first confirmed case was in April of 2009, and that ran for a little over a year until May of 10. And then SARS. That was the last one that with kind of the Chinese origination there, and that was back in the 2002-03 time period. And so, I think it's worth kind of looking at those three different epidemics, very similar now in kind of scope and spread and concern and fear out there about where we're dealing with the coronavirus. And still, you look at those, and each one of those lasted at least a year, and in some cases multiple years. And here we are in the coronavirus situation, looking at about 2 months, plus or minus a day or so. But we're looking about 2 months in, and so the biggest question on our minds, and certainly the minds of many of our clients, is, well, what has happened around those events in terms of markets? They're tragic events. Thousands of people have lost their lives as a result of these. And so we don't want to lose sight of that. But when it's interesting to dig into some of the data and look at the market reaction over those time periods, and it's pretty interesting. And so we'll have some more detail in a formalized published research paper in our daily equity report coming out later today, Wednesday, the 26th, as we're recording this. But I guess I'll summarize a lot of this data just as we're looking at it here, as what we did is we looked at those kind of start periods for each of those three epidemics and looked at market returns from the S&P 500 to global stocks, emerging markets, developed, to bonds and gold. And when you look across the board for at least U.S. equities, both large and small cap U.S. equities, in each of those environments, the start date to end date saw positive net returns, and in most cases, those returns were double digits. For instance, in the case of SARS, you go back to October 2002 until July of 2003, the S&P 500 was up over 12%. In the case of swine flu, now the timing of that being April of 2009, which was basically a month after the market bottomed, until May of 2010, small caps were up another 57%, S&P up 37%, and then Ebola in that 13 to 16 time period, the S&P 500 up another 15%. Wow. And so there certainly is precedent during these health epidemics out there to see positive returns from the market. But that doesn't exactly tell the whole story, and really doesn't tell the story that many investors experienced during that time period, as in each of those cases, when we look at kind of max drawdown numbers, there has been double-digit drawdowns in each of those different time periods. So that's all to say that these epidemics, historically, at least the three that we've seen, haven't led to catastrophic market events, but they have led to periods of increased volatility before they are able to resume and continue to move forward. So as we look at it today, market's off 8% from its highs. Wouldn't be a surprise to see some more volatility until the coronavirus situation resolves itself, which, maybe in a couple months, it may be another year from now before that the full scope of everything is under control. But having some of that perspective is certainly something useful, I think, as we're trying to navigate these markets.
Absolutely. And it can be especially helpful when you're in conversation with clients. We've gotten a fair amount of the phone calls. If we're getting phone calls, we're sure y'all are getting phone calls as well. People are wondering what to do, or at least what is going on. And information such as that is gonna definitely maybe help put some people at ease, or at least explain the situation a little more. In terms of looking at the current state of things as well, kind of how to move forward from here, well, that's kind of why we have the indicators that we have on the platform, right? I mean, we're still seeing the broad long-term strength from domestic equities as a whole across Dolly and asset class group scores. But in looking at some of the other indicators that we've highlighted in a few of the research pieces this week, such as the bullish percent charts that we have there under the technical indicator report, we saw most of the major bullish percent charts reverse down into O's. The BP NYSE did reverse into O's a little bit earlier, a couple weeks ago, and has continued lower. Current chart level there at 46%. And as we highlighted in the report on Monday, that's going to to be what we would call the yellow zone. So defense would technically be on the field with the bullish percent charts in O's. That doesn't necessarily mean dumping out and moving to cash, but there are some other helpful pieces in there in the report there from Monday that you could use, such as maybe substituting ETFs to hedge your individual stock risk, right? Some of these stocks, you mentioned the volatility, they're going to be moving around a bit more. ETFs might be a better route to look at, I guess, in the near term there. But really maintaining those stronger relative strength sectors in the market is going to be the place you want to be right now, whether that's through the Dolly rankings or whether that's through just identifying what sectors still have those positive relative strength against the market there. And then we highlighted a couple of those areas that have improved since the kind of outbreak started here in the report from yesterday and the ETF spotlight, looking specifically at some healthcare names that had improved, and then really utilities has continued to show strength. Showed strength for almost 18 months now at this point. It's been quite a while of that being one of the stronger areas that has held up there in the market. So definitely a great couple articles there to reference in terms of further talking points with clients, but also some potential ideas on how to move forward from this and what indicators to follow from here.
You mentioned, sectors, and obviously everything across the board since the market hit a new high have pulled back quite a bit. A couple of the areas you mentioned, utilities being right there towards the top of the list, has held up extremely well relative to 8% off for the S&P 500. The utilities sector, as defined by XLU, which is just a spider select sector ETF, down just 3%. So down less than half of the market in terms of the utilities, and real estate actually holding up very, very well during that time period. Another thing, too, when we look at this and you think about, obviously, the epicenter of the virus outbreak has been in China, with that spreading outside of China, but really starting in China. Lots of cases, that the vast majority around the world being in China. There's been many cases now in other areas, including Korea and Japan and Italy being a big one, and just today seeing one confirmed in Latin America and Brazil specifically. And so one would think that, when we think about equities, that the Chinese economy is just going to be crippled by this. The equity market is going to be crippled. But has that been the case? When we look at the China equity market, what's going on there? So
we definitely saw Chinese equities have a fair amount of weakness right at first, because they, as you mentioned, they were really the epicenter where it was starting to happen right at the beginning of this year, with some rumors going on, and then after that first death occurred in mid-January, fair amount of difficulty that we saw there. But one way that we can look to track the movement of those individual stocks in China in and of itself is through the Shanghai bullish percent, another one of the bullish percent charts that we have on the platform. And so this is going to be tracking some of the A shares within China, within the Shanghai exchange there, which we've seen have held up a little bit better than some of the other areas, whether it's investment in China through Hong Kong or through U.S. exposure. Obviously, a variety of different ways to get at some of those companies. But those A shares in China have been some of the names that have seen a little bit more return to positive strength here recently. And on that bullish percent, that Shanghai bullish percent chart, the ticker BPSH-SH there, that chart fell below 30%, which is typically the area where we start to identify within bullish percent charts to, okay, if you get a reversal back up to the upside, might be a place to at least start to get some names together, or at least look for some more positive strength. And then we saw it return back up into a column of X's there last week on February 18th, and it's crept steadily higher over the past few days, where the broader kind of global equity markets have continued south. So definitely a positive sign to see that continued strength there. And then when we're looking across at some of the other Chinese equity representatives, such as an A-share ETF, right? The Crane Shares China A ETF, ticker KBA, fell off significantly there right at the end of January. Did break through just to a negative trend there at 29 right at the beginning of the month here, but has since rallied all the way back up to now be bumping right up against that negative trend line, right at 33. Would need to creep a bit higher to return to a positive trend there, but definitely a good sign that we've seen that kind of continued follow through back to the upside from the broader A shares there as well. And a lot of the areas that have been taken or at least holding up better within the Chinese equity space have been some of the high growth areas that we've seen perform well in China for quite a while now. One of the first ones that comes to mind there is the internet space. A lot of those internet companies, whether it's Alibaba, Tencent, those are the bigger names that everybody really knows within China there. And one of the funds that has solid holdings in most of those is the Crane Shares China Internet ETF, KWEB, KWEB. And when you look at that chart, you never would have guessed that was a Chinese equity ETF based on all the news headlines. We're looking at 4 consecutive buy signals there. Most recently completed a bullish triangle right at the beginning of the month, reversed back up into a column of X's yesterday to set up a more near-term support level. It's currently sitting at $50. Near-term support is going to be right there at $48.50, and it's right around normalized trading levels too. So definitely a fair amount of areas that we're seeing within China that are kind of continuing to creep higher, which you might not necessarily expect given most of the international headlines there.
Yeah, it's really, really interesting when you look at some of those names that you mentioned in the Chinese equity space. Obviously, very, very important for Chinese investors. But the Chinese equity market is about 30% of the market cap of all emerging markets out there, and so the Chinese equity market is the market that is at the largest weighting within most of these broad-based emerging market products, and so certainly important market to look at there. So outside of that, in terms of just stuff that's happened this week and maybe not flown under the radar, but has didn't get as much coverage as the coronavirus to China issue has seen, have been interest rates. And earlier this week, interest rates moving to 10-week moving to all-time lows, 10-year, 30-year interest rates, so the yields themselves moving to all-time lows, and continuing to see that the yield on the S&P 500 index higher than the yield on the 10-year yield index, which is really interesting. But that has provided some tailwinds for areas we talked about earlier, so things like utilities, higher yielding things, interest rate sensitive areas, typically doing well as interest rates are going down. The theory there is investors looking for yield and income are going to the equity space as there's more income to be had over there versus in the actual bonds themselves because interest rates are so low. So real estate, utilities obviously up there. Like equities, interest rates now are very, very oversold in terms of their weekly distribution, in terms of their trading bands. So that'll be something to continue to watch. Would not be surprised to see near-term rallies in the 10-year yield or in interest rates in and of themselves. Unlike equities or unlike the S&P 500 or the U.S. equity market, the trends of interest rates are negative, where the trends in stocks in U.S. equities are still generally positive. Again, most indexes off 8 to 10% from their all-time peak, which was just last week. So, we're a week removed from all-time highs on these equity indexes versus interest rates and the 10-year yield index itself continues to be in a negative trend, has been in a negative trend for a couple of years now and continues to just push to new 52-week lows. And again, that's on the interest rate side. Oversold, wouldn't be surprised to see near-term rallies, but long-term trend of interest rates is still negative today.
And a lot of these areas, we're speaking here on Wednesday. These are all, Wednesday's definitely our longest report day, so we'll be highlighting a lot of these in a little bit more in-depth fashion in the report today. But another point I wanted to touch on the daily equity report that we have, an event that we have coming up here pretty soon, is a China update webinar, a special update webinar that we have tomorrow. So this is going to be, we're very excited to have Brendan Ahern, who's the Chief Investment Officer at Crane Shares, joining us for a special update webinar on how the coronavirus has affected markets in China and how it's affected markets in the U.S. here as well. So that webinar is going to be held at 1 p.m. It will be recorded. We do realize it's a little bit short notice on terms of announcing it there, but if you do register there, you can register through the Were You Aware. It will be recorded. You will get a replay of that will be available, but we hope that everyone or anyone who wants to learn more about it can join us tomorrow at 1 p.m. To hear from us.
And these Brendan specifically, you mentioned Crane Shares as a company is as closely tied into the Chinese public the Chinese investment landscape. They are China when it comes to being experts in the space. So it's going to be great to have them on talking about what's going on, boots on the ground over there, what's going on in China right now, from an investment landscape, from a general virus landscape, from an update, and then Ian will provide an update from our view and how the markets are playing out. So be sure to at least sign up for that. Because it is during market hours, and understandably there might be some volatility that you need to talk to your clients about. But be sure to listen to that, and that's going to give you some great ideas, great perspective in terms of what's actually going on in China right now.
Absolutely. And then we do have another upcoming event as well that we wanted to highlight. We had opened up the registration there last week for the Spring 2020 Point and Figure Institute that's going to be held this year in Las Vegas. And so we have two Point and Figure Institutes, one held in the spring in Vegas, and then one in the fall here in Richmond. The spring one it's a 2-day event. It's going to be held April 23rd and 24th, and we're running close to the time that goes up for early bird pricing. So it will save you a little bit of money here if you do register in the next few days. If you want any further information about that, again, April 23rd and 24th. It's going to cover a variety of content. Most of the analyst team is going to be out there to meet with us, but then there's also going to be over or close to 100 other advisors out there that use the research, that use the platform, and each of them are probably going to use it in a little bit different way. Some of them might be worth networking with to figure out better ways that you might be able to apply their use case to your business there. So definitely a great opportunity there. And again, you can register for that through the Were You Aware as well.
Yep, that's great. And early bird registration cuts off this month, so just a few more days to get in there at the early bird price. And it will be open. Registration will be open for a little while longer. But if you want to kill two birds with one stone, and you happen to be a football fan, the dates, April 23rd and 24th, that our event is being held coincide with the start of the NFL draft, which happens to be held in Las Vegas this year.
In Las Vegas. So you can come and learn some more about Point and Figure and see your team draft the next Rookie of the Year.
There you go. There you go. Sounds great.
Wonderful.
Well, Ian, appreciate it. Always good to be on talking about the markets, very specifically, very topical information about coronavirus going on, about China in general. And at the end of the day, it's about having perspective and maintaining perspective on the market. The best way that we know how to do that is through listening to the market and listening it through the lens of the Point and Figure method of technical analysis. And so if you have any questions, please feel free to reach out to us directly. Email address, you can reach us at dwa@dorseyright.com. You can always reach us by phone at 804-320-8511. And as always, we appreciate you listening this week and look forward to talking to you next week.